Are you ready to become a change maker? Our 48-week postgraduate program in public policy or the PGP may be just the thing for you. This hybrid program is designed to give you both the theoretical foundation and hands-on experience needed to excel in policy making. With a mix of expert-led webinars, in-person workshops, and policy simulation exercises, you'll gain real-world skills along with personalized mentorship. Through our policy programs, we connect good people to good ideas and good networks. Apply now at the link in the description to make an impact.
Welcome to All Things Policy, a daily podcast by the Takshashila Institution. We are a bunch of policy nerds based in Bengaluru, and we like bringing fresh perspectives to Indian affairs and Indian perspectives to global affairs. So grab a cup of coffee, sit back, and join us for today's chat.
Hello, welcome everyone to this new episode of All Things Policy. Today we are going to talk about a class of investors that are powering Indian startups. Every other day we come across news stories about Indian startups raising millions of dollars, billions of dollars in India, right? For instance, few months back we had the news that Zepto raised another $350 million. And very recently, there's a company called Darwinbox, which offers HR services. It has raised $140 million. So how are these Indian startups raising this money? And why are these specific class of investors that we call venture capital firms are funneling so much money into Indian startups? So to understand this ecosystem, the venture capital ecosystem, to unpack it, to explore it and explain it, we have with us Shobhankita, who is a research analyst with the Takshashila Institution's High-Tech Geopolitics program. And she has also been previously associated with the early stage venture capital industry before joining Takshashila. And I am Lokendra, and I also work as a research analyst with Takshashila. So, Shobhankita, dive right into it. So I'll start with a simple and broad question. What is venture capital, right? Why does it even exist? Are the existing market mechanisms that we have, let's say the share markets, not sufficient in taking care of the funding needs of the startups? Why do startups need a special class of investors in the first place?
Yeah, thanks, Lokendra. So let's think about this in terms of incentives and the willingness for risk, which is to say that a bank will only give you a loan if they feel that they will get the money back in principal and the interest. Public markets are a different type of asset class in the sense that these are well-established companies, profitable, and then, public retail investors and institutions invest in the public market. But what happens when you have a very high-risk new idea that is yet to be unproven, but that might have the potential to become very big in the future? And it has nothing going for it today except the idea which might be only in the minds of a few people, which might be the founders of the company. Banks are unwilling to write loans for a company like this because it has no assets on its books. Why should the share market even entertain something like this? Because there are no assets, there is no profitability, there is no books. It's still very early, it's still very nascent, and there's a very high probability that these companies might fail. So there is a very high risk, high reward scenario here, which is that many of these companies are going to be successful in their ideas, and many of them will go on to become next generation companies that are generational, and almost a few companies like that come in every decade. But the problem is many more of these companies are going to fail. So it's a very niche kind of asset class in terms of very high risk, very high reward, and not many people are willing to double their wealth or even investment into companies like this, which is why venture capital investors exist. So venture capital firms take money from what are called limited partners, This can be family offices, just very high net worth individuals. This can also be institutional investors, um, such as banks, pension funds, and so on. So we have a lot of pension funds from the US coming into Indian startups. The government of India, through a fund of funds called SIDBI, also invests into venture capital
Sorry,
funds.
what is that? SID?
SIDBI, SIDBI.
Okay.
Yeah, SIDBI also is a fund of funds mechanism which channels money into the venture capital ecosystem. So we have these people who are limited partners that invest money into venture capital firms, and venture capital firms then score the market for investment opportunities into early stage startups, and then they invest in what they think might be generational companies of the future. And the reality of this even is that most startups fail. So 90% of all startups fail. 50% of all startups that any venture capital investor invests in will fail. But regardless, the companies that do make it, that are successful, have a power law return scenario there, which is that.
We'll circle back to the power law and we'll ask you to explain it in more detail, because I think that is the guiding sort of law for the venture capital industry in India. Okay. But before that, if I understand you correctly, then it seems to me that banks and the share market, right, two existing mechanisms through which any company can raise funding, are unwilling to take that level of risk to invest in an idea, something that is essentially is in the ideation stage, has yet to be implemented, right? If it's about a robotic, let's say if the idea of a startup is to make robotic arms for automobile manufacturers, for instance, and just giving an example, then they've not done anything about it. Just maybe they have done some R&D around it. They have some ideas on as to how they can build this, but they've not actually established a factory. They have not actually hired people to do it, and so on.
Or even if they've done all of that, they might not be consistently profitable or making revenues from it.
So one thing is it may be in ideation stage without actual implementation. Another thing is it may be implemented at a lesser scale, but they would not have a proper revenue stream, right?
Yes.
So for instance, if you were to found a startup in Bangalore, let's say, uh, join the bandwagon and launch another food delivery or grocery delivery startup and say, these guys are doing it in 10 minutes, I'll do it in 5 minutes, I'll use maybe drones to drop things at your doorstep and so on, right? And maybe you have built the app, you have bought some drones, but your scale is small, you're reaching maybe a neighborhood or two, and you're not generating so much revenue. You have put a lot of investment, initial one. Then if you approach these venture capital firms, right, they would see the value in your idea.
Yes.
And be like, okay, this is something that can be scaled beyond a neighborhood.
Yeah.
Right? That is what essentially they're doing. And if the same company were to go to a bank or to a share market, they wouldn't be happy about investing in these.
Yeah, because they have no way of seeing that this investment will pay off for them. Venture capital investors are okay for many of their investments to be written off because they are aware of the business model in which they're working, which is that very small percentage of the companies they invest in will deliver all the returns and more. And many of them would have been, the high risk and write off, and companies will fail, and that's okay because the companies that win will make up for everything else.
Sure. Then let's talk about the power law, right? So we have hinted at it, right? So some would fail, many would fail instance, right? And some would generate all the returns for them. Because at the end of the day, there's a bottom line that even venture capital funds have to meet, right? Even they have to pay their employees, they have to maintain their services, right? So there's a cost that they have to pay to survive. And they also need to give returns to people who are investing in venture capital funds as well.
Correct.
So this power law thing somehow helps them meet the bottom line. So how does it work?
Yeah, so which is basically to say that every decade we have a few companies that will go on to change how people in the country will kind of deal with services, right? For example, Zomato was that kind of a company. Flipkart was that kind of a company. Honasa, which is the parent company of Mamaearth and a few other consumer and care companies, that was one kind of a company, right? So these are companies that change how citizens interact with each other, get access to services, and so on, right? So what you want to do as a venture capital investor is at least have one such company in your portfolio, and that kind of meets everything else for you in terms of the power law, in terms of being able to return all the money that you've lost in all the other investments. So which is to say, even if you were a very small investor in Google in the early days, it didn't matter what other 20-25 companies you invested in, which all could have been a written off, but Google alone would have given you all the kind of returns, right?
When you say we look at really good returns, what is the scale we are talking about? 10x, 20x, 30x?
Yeah.
For our initial investment, what is the scale?
Yeah. So, I mean, if you look at, for example, funds in the US, they have returned all the way from 80x to 100x from one single investment.
Or which time period are we
So this would be over the last 25 years, right? I mean, look at any of the generational companies such as Airbnb, Snapchat, Facebook, Google, Tesla, all of these companies for their early stage investors who took the bet when nothing was there in the company, they would have returned, upwards of 100x.
Any Indian example of?
Yeah, so I think Flipkart was a massive outcome for the investors, such as Axel and so on, right? So Flipkart, when it got acquired by Walmart for a massive 16 billion acquisition outcome, that kind of had a lot of windfalls to their early stage investors, as did Zomato and Honasa for, say, their early stage investors, right? So many of these companies will do really, really well, and that's okay for the rest of the portfolio.
Sure.
Yeah.
So when exactly did investors realize this power law thing, and when exactly did venture capital as an industry emerge? I'm sure it might have not emerged in India, maybe somewhere in the West. I'm not sure, right? When exactly did it emerge and how? Do you have any idea about?
Yeah, I'm not really sure of the historical roots here, but I think there is a case that this is at least 200 years old in its primitive form, right? So back in the day, apparently they would bet on ships. They would bet on ships and their voyages, because if they could come back, then there was a lot of value in the goods that the ship would bring back. But a lot of ships would be lost in the voyage. So they would pool money of people willing to take that risk, and they would get the windfalls of the final returns from the goods that used to come. So this is, at least 200 years back. But venture capital in its modern form of investing into private limited companies and so on, I would say at least is 50, 60 years old in the US. And in India, at least now 20 years old.
So is it maturing in India right now? Or what stage do you think India is in right now?
So I think it's fairly still nascent, right? I mean, it's not mature, clearly. If it's mature, then we would have seen a lot more exits coming out of the ecosystem. Exits being that the company either got acquired or merged with another company, or it went IPO, right? So any way that the money that was invested into the company kind of cycles back and circles back into the funds that invested in the company, that kind of a full cycle, we've not seen too much of that happening in India. We have seen a lot of money going into the startup ecosystem, but because these startups haven't had that many exit outcomes, we don't see this money coming back, which is why we have so many really large unicorns on paper that are not going public, and the value is just locked in on paper valuations for these companies, right? So because of this, I would say it's still in the fairly early stages. It's only when the entire cycle of exit and so on comes back in terms of the money being recycled is when I would say it would be.
Shobhankita, we'll circle back to the exit problem, I think, at a later stage in this podcast, because I think exit is a problem that needs a more detailed sort of treatment. But for now, I think you have broadly answered why venture capital exists, right? I think that you have answered well. My next question to you in that direction would be, let's say there is a venture capital firm based out of Bangalore or Mumbai, right? And they want to fund tech startups, right? Any tech startup, for instance. What would be a typical month or year for them? Like, how do they operate right, on day-to-day basis? How do they select which startups to fund, and how much. So can you give us some basis around how this fund will operate?
Sure. Okay. So a venture capital firm is regulated in India in terms of the alternate investment firm, right? So the AIF category that SEBI has, it is a part of that. It's one of those such categories. And it would need, for example, for the founders of the venture capital firm to be able to raise money from people who have the money. Of course, they would need to put in a little bit of their own wealth to show skin in the game, but otherwise they would need to reach out to enough people who will trust them to give this money, right?
And they will make a promise to whoever they are raising money from that, see, these are the returns you get from mutual funds, these are the return you get from banks, these are the returns you get from best performing assets in the share market, but we will give you this much return in this much time period.
Correct.
Are they making these promises?
Yes. So, for example, the kind of people who are investing into venture capital firms, they might be doing it as a portfolio diversification strategy. They're likely to have family businesses or businesses in which they are maybe top leadership and they own large shares of. They will have exposure to real estate. They will have exposure to gold. They will have exposure to public markets. They will, of course, have a lot of money in government bonds or fixed deposits.
Okay.
Right. So they have a whole range of wealth already in different asset classes. Sure. This could be one way for them to diversify their portfolio. And many of them might also have a personal interest in understanding and tracking latest innovations coming out of the startup ecosystem. So this is their way of having a ear to the ground as to what's going on in the Indian startup ecosystem.
And also maybe personal motivation to nurture certain ideas.
Yeah.
Okay.
So, for example, somebody who's done very well as a founder in his or her own life would want to give back to the next generation of founders, right? So that could be another. So the pitch that the venture capital firm's partner or the founder is making to these limited partners is that I have a particular strategy that is today underserved by the market.
Okay.
So there is this certain class of startups that are today not being served by other firms.
Sure.
I have this particular strategy which I'm going to go on to deploy after you give me the money.
Sure.
This is going to be my fund size.
Sure.
This is going to be my management fee, which is going to be my cut for my salary, for my team, for my travel, etc. And from this money, I'm going to invest. And if everything goes well, according to my strategy that I'm laying out to you today, I will be able to have this kind of returns to you 10, 12 years down the line. So in terms of the venture capital firm timelines, it is 4 years of deployment. So 4 years, you're investing into startups. After that, you're essentially harvesting your investment, which is that you're not actively investing the same money, but you're getting the returns and you're waiting for the exits and the follow-on fundraisers of your startups to go on. So what happens is that for the first 4 years, you're investing. The next 6 to 8 years, you're waiting on these investments to kind of reap benefits. So this again, 4 plus 6 kind of a model is copy-pasted from the US. This is not really suited to our ecosystem particularly, but it is a copy-paste from the US. And
why is that the case? Why is it not suited?
So I would say it is not suited to the Indian venture capital or the Indian ecosystem overall, is because this is not the time period that we have seen exits work in India.
Okay.
Because for the next... So 4 plus 6, right? So when I say in these 6 years, we want these returns flowing back to the LPs, those returns are possible only through exits coming in through acquisitions or IPO. And this has typically not happened. So we have, again, like I said, large companies that are sitting on large valuations in the private market.
So do you think we need a longer time frame?
I think that would be very helpful. I think we would need to tweak exit timelines to the Indian venture capital and Indian market scenario. But having said that, we are beginning to see early stages where the Indian markets are also open to IPOs from startups, right? So Zomato is one.
There are different kinds of VC firms. Some would be early stage investors, some would be middle stage, and some would be later stage, right?
Correct.
So all of them have identified which at what time in a startup's life journey they would be jumping in as an investor.
Correct.
And it is very much possible for a big startup, right? Initially there would be one investor, then in next round there will be another, and later there would be another before they go public maybe and do the IPO route and so on. Now I'll ask you to take a step back and answer the following, right? Let's say I am a researcher based out of IIT Madras or IIT Bombay. And along with my friends and colleagues, I come up with this idea, any idea, right? Any tech product that I'm planning to make. And I approach your venture capital firm, right? A random XYZ venture capital firm. And I say, look, I have this idea. I make a presentation to you. What is the evaluation criteria? What are the strategies a typical venture capital firm in India will use to decide to fund me or not? How does that work out?
So you're talking about a very early stage.
Yeah, very early stage.
So you're essentially an
Ideation stage.
on a presentation at this point,
Sure.
right? So a venture capital firm will first look into the idea itself. How close or nearing commercialization is it?
Sure.
What is the business potential of this
Sure.
idea? It can be the greatest technological innovation, but venture capital firms are not investing in theoretical
Sure.
physics or science ideas, right? We're looking for ideas that
Have applications.
have application
And can be scaled.
Have consumer need,
Yeah.
have customers willing to pay for it.
Sure.
And of course the founder's ability to navigate this entire maze of finding customers, pitching to customers, figuring out the go-to market, figuring out the pricing structures. So there are multiple risks in this startup, the way I see it, because it's so early at this point, right? So firstly, because it's an only idea stage, I'm going to ask, what is the product that you're going to build out of this? What is the business case for this? What is the market trend look like for this particular sector that you're looking to build in? And I'm going to triangulate all of this and then decide, if I want to take the risk, how much can you reasonably achieve in the next 2 years or so from my investment? Because I'm again bound by my 10-year timeline, right? So what reasonably can you achieve in the next 2 years after taking in money from me?
So, as I understand, the venture capital firm is doing some form of market research also, right?
Very much,
Very
yes.
much, right?
Very much, yes.
And you said pitching to customers, as in,
Yeah.
are venture capital funds also helping these startups reach customers?
Some of them, yes. So many venture capital firms have what are called platform teams, which help in operations, hiring, legal,
Okay.
these kind of operations for their portfolio companies.
Okay.
Because if I have a portfolio of about, say, 20, 25 companies that I've invested in, and all of them are early stage and all of them need to figure out compliance, I might as well centralize it for them and help all of these 25 founders, right? I mean, that's a value that I'm able to provide to them as well. So I'm able to channelize some of these processes for all of my portfolio companies. So I can even help you with reaching out to customers. I can also help you with your legal, compliance, hiring, so on and so forth.
Is this a sign of maturity, in the some level of maturity? Because, see, I would assume that in a new industry, let's say the venture capital ecosystem maybe 30 years back, maybe in somewhere in 1990s, is just starting to emerge in India. At that stage, I think even the idea that a class of investors will invest in an idea would be very new to the Indian market. And slowly, when they get good at it, maybe a decade or two, when they've done multiple iterations of the same exercise, when they have successfully employed the power law, given great returns to their partners, limited partners as you call them, right? At some point they realize, okay, we have done multiple iterations. There's a standardized way of doing this. There's a way we can, streamline, standardize the whole process, maybe offer some services to the startups. We can help them scale also, right? It's in our advantage.
Yes.
If we can invest maybe a minuscule amount, right, a small amount into these platform services, as you said, and help them scale, right? Maybe we are increasing the chances of our portfolio performing better. So this looks to me as some sign of maturity.
Correct.
And if the Indian VC ecosystem is headed in the right direction, we'd be seeing more of such nurturing sort of venture capital firms going forward. Is that how you see it?
Yes, I think that's a right assessment, which is that, see, once a venture capital firm takes a percentage of equity in a startup, it is almost a co-owner of the startup, except a minority owner of the startup, right? I mean, a venture capital investor might take 10% of the startup, 15% of the startup. It's almost a co-owner. And if the startup doesn't do well, that 15% that the venture capital firm has invested in is worth nothing. So it is in the interest of the venture capital investor to do this. But the way in which this has become almost like a department inside of the venture capital firm, apart from the investment team, I would say yes, you're right, that this is this is a good sign for the startup ecosystem. The caveat being that despite these, we do still have the high number of fraud cases in the ecosystem, right? Where founders have fudged numbers. There has been cases where, after a few years, we have realized that the books have been fudged. Chartered accountants then come out and show that there's been some kind of fraudulent activity. So I think that is the caveat to say. But I think in the direction of the venture capital fund in the ecosystem, this is a positive one.
Okay. At this stage, I'd like you to pivot and we'll focus on a very specific VC firm, right? And I think there are very few which does focus on deep tech in India.
Yeah.
Now, first, I request you to explain what deep tech is, right? Why is it even more difficult to invest in deep tech? I mean, it's difficult in the first place to invest in ideas and tech startups and so on. But why is it even more difficult to invest in deep tech? And second, how are these deep tech VC funds overcoming these difficulties and challenges?
Sure.
And what is their bottom line? How are they finding it?
Sure. Yeah. Okay. Before I jump into what a deep tech startup is, maybe this is a good time to clarify what even a startup is, the way a venture capital investor would define it.
Sure.
So, for example, if I started a lemonade stand outside tomorrow, in my mind, that could be a startup. But a venture capital investor would not consider it a startup. Similarly, a kirana store that opens outside my house, a venture capital investor would not consider that a startup. I mean, some reasons are obvious, which is that both these ideas are limited by the geography in which they operate. These are not new ideas. Both the kirana store and a lemonade stand have been around for generations. At the same time, these are not going to grow really, really fast in terms of how quickly can revenues grow year on year. However innovative the models can be, there's only that much that is possible. So I would posit that a venture capital investor defines a startup as something that can potentially give exponential returns in terms of very, very high growth. So you're looking at a startup as something that grows really, really fast year on year, and say 4 years down the line, 5 years down the line, it's already a sufficiently large company, and yet it can grow that much larger the next year, right? So, what this means is really high year-on-year growth. And secondly, that the market problem for which they're solving needs to be that big that this much faster growth can still be accommodated, right? So I would say that these two are largely what a startup is, how a venture capital investor defines them. It's easy to dismiss with this definition that only software companies fall into this category, which is that software companies, yes, can scale really fast. They don't really need a lot of real estate or infrastructure or so on. And so software companies are venture capital investable for sure. But that's not fully true. For example, look at what HUL and PNG have done for consumer over 30, 40 years, right? I mean, they have managed distribution. They have figured out channels to distribute their consumer care products to India. And they've built this over 30, 40 years. And something like Mamaearth pretty much disrupted this business model and in 7 years was able to go IPO. Right? So think about what was built over 30, 40-year time period versus what something like a Mamaearth has now done in just 10 years of existence. Think about companies like Zomato. With the coming of the internet, so much changed. And in say about 10 years' time, they were able to change consumer behavior. Think about, say, financial services, right? We have always had banks and NBFCs, but then startups came in and said, we are going to innovate on payment gateways like Razorpay did. They can do lending platforms online. They can do micro insurance online. For example, Go Digit Insurance and Acco Insurance, which went, so really large companies at this point in time. So all of these are business models that are new age, that are servicing a need that previous companies didn't service, and today are really, really large, and they're able to have done this in a fairly short period of time as compared to their legacy incumbents. So I would posit that it's not just software companies that are mentioned investable, multiple others are also. With this entire, I think, sort of an explainer out of the way, let's get into deep tech, right?
Okay.
So deep tech being, I would say, anything that is R&D first, which is that for example, something like a Zomato, the real challenge for Zomato was operational excellence,
Sure.
was being able to get multiple restaurants on board and service the deliveries and ensure that the delivery partners and the locations in which they're located is highly dense, and to be able to have an app that works and do all of this triangulation for that food from the restaurant to reach the consumer. So it's a very operational business. But if you look at other sectors, right, for example, industrial manufacturing, AI, if you look at augmented reality, virtual reality, space, green hydrogen, energy transition, lithium ion batteries. So many of these other sectors where the crux of the business is not in the operations, but really in the science and tech innovations that the startup has kind of introduced. So I would say companies like that would qualify broadly to be deep tech startups.
So, okay. Can you give us some examples of deep tech startups in India?
Yeah. So let's think about a company like the E-Plane company, which is today saying that they will build eVTOLs, which is vertical takeoff and landing and completely electric, right? And they're going to be able to have really large drones, for a lack of a better word, but can carry, say, a few tens of kgs of cargo and be completely electric in their nature. That's a new idea. Not just really lightweight drones, but really large cargo carrying eVTOLs that can do vertical takeoff and landing and bypass traffic and bypass other use cases, for example, ambulance, for example, commercial transportation, and so on. So I would say just figuring out the technology involved to be able to design and manufacture something like this particular eVTOL itself would be very, very challenging.
So maybe startups in the quantum space, in the space sector,
Correct.
maybe in jet engine space,
Correct.
a lot of them will qualify, right?
Correct.
Some things I can maybe, correct me if I'm wrong, right? Some things I'm able to discern from your description of the deep tech startups. First is that they're still in the R&D phase, right? So they have still not reached a stage where they have a demonstrable product or service or a strong idea to pitch. Right?
Or at this particular stage, the technology risk in the startup is very, very high. The technology hasn't been figured out yet.
Sure. Okay. And everything is subject to that. If the technology is somehow figured out, the idea would work well. Correct. Right? That is the underlying understanding.
Provided the customer need for it is kind of sorted out for. But at this stage, the problem for the startup is not that there is no customer need. The problem that the startup is solving for is very real. So talking about my eVTOL E-Plane example, traffic is a real problem in congested urban spaces in India. But the solution for that has a technology problem, which is that traffic is a real problem. We need urban air transport, but a way to do that at prices that are economically feasible, to design these kind of eVTOLs that allow for the technology to be de-risked at scale for multiple consumers, for this to be a viable business model, is where the challenge and deadlock is.
So, okay, R&D is there. I do see some inclination for emerging technologies.
Yes.
Right? So deep tech startups would mostly have to do with emerging frontier sort of technologies. So all these quantum and space and others, jet engine will all prop up. I'm also thinking that maybe this will have a long timeline of returns. So long timeline for investment, then having patience for the product to actually come about, and then so can we say this is one step before early stage venture capital, right? In a way, if there was a spectrum of VC funds, early stage, middle stage, late stage, I think this is going even one step back before early stage, right? When the thing is in the R&D phase. So can we also say then that deep tech VC funds are actually helping India's R&D ecosystem by funneling private money into research that has a lot of applications or of scope? Because if it is fundamental R&D, and as you said, some of these technologies have still not been figured out properly.
Correct.
Maybe eVTOL, maybe if a company figures out eVTOL, or a company figures out how to manufacture jet engine and so on, maybe that will have across the board applications, across the board usage, not just for their own model, right?
Yeah.
If this company was able to show eVTOL is doable in Bangalore and they launch their services, there'll be tens of other such companies springing almost overnight in Mumbai, Delhi, and like demonstrating the same thing because the technology has been figured out. Right?
Yeah.
Similarly,
So I would say that's not fully true, right? I
Okay.
mean, firstly, yes, you're right that in terms of commercialization, many deep tech startups would be prior to even early stage software or other sector startups because they are not yet able to be commercialized. But early stage startups of any other sector can start churning in revenue. Right. So software companies from day one can start getting revenue, so as financial services, so as consumer, and so on. But deep tech particularly has longer time for the first commercialization to happen, which is for consumer money to flow in. It takes a lot of time for the business. Having said that, how the venture capital ecosystem is arranged is that you can still have Series B deep tech companies that still see zero revenue. Right? Because they have figured out other things the technology front that have been de-risked. Maybe they have letter of intent from customers that provided their technology is de-risked and have a successful showcase of their product, they have customers willing to come in. At every stage, they're being able to figure out a few other things in technology that even they can keep raising venture capital money, but even at Series B stage are zero revenue. Although, for example, in software and consumer, you will not find a single example of that. So purely from that perspective, I will say, yes, from the commercialization perspective, for a long time, deep tech is going to be not viable to get consumer money, unlike, say, early stage for other sectors. But it's not fully true because you can have the same journey of raising money, even though you are zero revenue, because people realize that once you figure this out, you can churn higher margins and higher revenue from your consumers.
Okay. But I'm trying to make a larger point here. Okay, India's R&D ecosystem, right? It has lot has been written and spoken about it that the R&D spending in India is quite low, and we have only few centers of excellence that way. IITs come to mind, maybe some labs here and there come to mind, right? Isn't then deep tech VC a great idea?
Yes.
To channel private money into R&D.
I would completely agree with you there. It is. See, we are unfortunately in an environment where large public spending into R&D has kind of tapered off, right? I mean, the efficiency in terms of outputs from this investment is not that high. And private R&D has also kind of tapered off in the sense that most private companies in India are not investing very highly into R&D and new innovations. So I would say in an ecosystem which is like this, what deep tech startups are doing is phenomenal. The kind of challenges that deep tech startups face is almost insurmountable. And yet, the kind of innovations and sectors and ideas that they're exploring with is a great service to the broader R&D ecosystem in India as a whole. There, I would completely agree with you.
Sure. Okay, let's pivot again, right? And I think you had touched upon some of the challenges venture capital in India faces in the early stage of this podcast, and you spoke about exits, right?
Yeah.
Whether it is a deep tech venture capital firm or whether it is any other venture capital firm funding any kind of startup, right? Be it deep tech or not, so on. I think exit is a problem, right?
Yeah.
Venture capital VC firms should be able to exit from their investment in a startup when they feel it is going downhill or it's not giving them the returns they promised and so on. So can you explain the exit scenario to us and this challenge, and then we'll come to other challenges?
Yeah. So I would say if a company is going downhill and if a company is struggling, it's understandable that a venture capital investor will find it difficult to get out of this startup because there would be no buyers for a company like this that is struggling. Correct? So I would say successful exit scenarios are when companies are doing well, there is demand for them, and they get acquired by larger companies that are existing. The other example might be when some of these companies that are doing well begin to go IPO and begin to raise money from public markets, from retail investors, from other institutional investors, from mutual funds, and so on, right? So going public is one way. And the third is when the founders themselves decide maybe to buy back the company and take it private, or for another investor to come in and then buy the shareholding of the previous investor. Right? So, for example, a Series B investor might buy out a seed stage investor into the same startup. So, these are broadly scenarios where the startup kind of gets successfully exited by a particular venture capital investor, which is through mergers and acquisitions, through IPOs, and then follow-on investors or the founders themselves taking home. All three are possible. One, when the company is doing really well and there is demand for the shares of the startup, because it is a supply-demand game at the end of the day. And the second is when we have an ecosystem that does this more and more, right? For example, the US has a lot of companies that are very quickly getting acquired and being merged, because that is the kind of ecosystem they are in. But unfortunately, India is not there yet. And we also have these scenarios of really large private companies that are not going public, which means that the wealth of the companies remains on paper and not really gets recycled back for the investor. So I would say that is one problem, which is that if you compare just the amount of money that has gone into the Indian venture capital ecosystem versus what's come out, even as late as 2023, what's come out is a fraction of what's going in. And that definitely is not a sustainable.
One big problem. What would be other problems with the ecosystem?
Yeah. So I think the other one might be that because a venture capital investor is bound by the timelines, like I said, of 4 years of deployment and 6 years of harvesting, at max a decade, they're unwilling to experiment with ideas that are not yet closer to commercialization, which really hurts deep tech companies, right? Because many of them might still require a longer term research environment, prototyping environment.
So basically, we need more deep tech focused VC firms.
Yes. So we need, firstly, more deep tech focused VC firms, which I think is a market problem, which is that if many more VCs felt there was that much more money to be made out of the ecosystem, they would definitely start focusing on the sector. But today, the problem is that because of these timelines, the early stage startups that require a lot more hand-holding in terms of infrastructure, in terms of talent, in terms of space, just don't have it, and they don't have money coming in from a VC because the VC themselves is bound by timelines. So I would think a lot more
relaxation of the timeline.
Yeah, I think that would be helpful, and I think there needs to be a longer conversation about extending the timelines, at least in the Indian context, from 10 to say maybe 15 years or so, 12 to 15 years. And that's a longer conversation that requires multiple stakeholders to agree. But I think in the early stage, government grants would be quite helpful because technology readiness levels 1, 2, 3, and 4, which is really the early stages, are not what a venture capital investor is willing to come in and invest, because they do not see returns from that at all. And once they deploy money, their need for compounding that money kicks in, and they're bound by their internal rates of returns and so on from that money. So they're not going to be investing. So I think more government grants at that stage would be helpful. I think there are also other examples in the West that we can look at, right? For example, Venture Studio, where venture capital firms themselves incubate companies. And the venture capital investment team members are almost co-founders or part-time founders of the company. And once the company does significantly well, it branches off on its own outside of the venture capital system, right? So, for example, Moderna actually came out of a venture studio in the US, right? So,
and it has been widely
successful. It's probably the most very well-known company that has come out of a venture studio in the biotechnology space. So I think we can experiment with more of such ideas. For example, BITS Pilani recently came out with a PhD program where they support your research during PhD turning into a startup idea. And they kind of support the PhD researcher to convert that, right? So we should be able to have some of these different ideas be experimented with and see how we can do a lot more multi-stakeholder kind of a thing, right? So we need, for the R&D ecosystem and also for startups, multiple things. One is academia, industry. For example, how wonderful would it be if we had the problems that the industry faces and the research questions and the technology innovations required there kind of given to IITs and so on for them to kind of then think through and come back with solutions, right? I mean, that kind of a cross collaboration between industry, academia, students, researchers, all of that would be really, really
What
helpful.
about the regulator for the industry?
Yeah. So I would say we have a regulator that's done extremely well in terms of consumer protection, right? So
this is SEBI.
This is SEBI. Yeah. So SEBI, obviously regulates largely, venture capital firms as well as other kinds of asset management companies. So I would say in some ways, SEBI has been quite arbitrary in some of the rules that they have imposed, right?
Sure.
So, for example, when I was working in venture capital for almost about 12 to 15 months without any prior notice and without really an understanding as far as, for example, we were concerned as to why some rule like this was passed, we were not allowed to invest abroad, which really, was a problem for us because many software companies like to have their headquarters abroad in the US, and then they have Indian subsidiaries of the startup because they feel their consumers are there, the market is there, the sales team is going to be based out of the US. They want a legitimate US address because they want to come across as legitimate for their US consumers. And we just couldn't invest in the parent company of the software companies, right? So arbitrary rules without notice or without explanation, I would say, is one way where, despite consumer protection, it hurts, or it's at least a friction for the venture capital investor. So I would say at the regulatory level, at the ability for exits, the conducive ecosystem for exits and acquisitions to take place at the early stage, for grants to come about, also for the stakeholder, multi-stakeholder cross collaboration between multiple pillars of the ecosystem to come together, there's a scope for a lot of improvement that ultimately benefits the startups to be able to do more with less.
I think we would like to end this podcast at that note, right? There's so many things that can be done. See, my understanding is that Indian startups are very integral to the Indian growth story. We need these startups to succeed, as many of them can. And we also need to encourage researchers, right, and in all these institutions to come up with these ideas and be confident that if their ideas are good enough, there will be some investor at some corner willing to bet on their idea.
And we should also have ability for the technology licensing for some of these ideas to be passed on quite well. And US in the earlier days did it quite well, right? I mean, it doesn't matter what your idea is, but with the invention of a patent or a licensing model for this idea, other people can take the patent from you and run the mile of having that company.
There are many models and ideas we can experiment with and implement. So I'd like to end this podcast with this note to our listeners. Think of ways in which India's venture capital ecosystem can be improved, can be bettered, so that it works for Indian startups. Because ultimately they are the beneficiaries of the system, right? It has to work for them. Right? So if you have views how this can be done better, do write to us, do reach out to us at Takshashila. And with that note, we conclude this podcast. Shobhankita, thank you so much. I think you did a great job in explaining a lot of terminologies and processes around the venture capital ecosystem. And personally, I have come out of this podcast with a far deeper understanding than I had previously. So thank you so much.
Thank you. Thank you for having me.
If you liked our show, dive into Takshashila's research on technology, strategy, and economic affairs. Check us out at our Twitter handle at Takshashila INST or our website takshashila.org.in.